Monday, February 9th, 2026, Monaco 64, home of alternative economics and contrarian views. Well, we're going to look at the bond market and in particular something called yield curve control. There's speculation that the new Fed chairman, Warsh, will want to reinstate that kind of policy. And I'm going to give you my opinion on what could happen in relationship to that and why it's no panacea for the debt monstrosity that we have, not just in the States, but anywhere else, actually. Before I do, I like to give a shout out to one of our long-term affiliates. It's Dirty Man Safe. So Dirty Man Safe is it's a good way to hide, secure, and retrieve your valuables with ease. Yes, in this day and age where private property has been attacked, not just physically from bad actors, but also by government through inflation. It's more important than ever that you safeguard some of your property with Dirty Man Safe. And yes, we have a link below in the description for a landing page. And if you're interested, you'll get 10% off by using my link. Yeah, have a look at Dirty Man Safe. So back to yield curve control. Well, let's look at the history of yield curve control in the United States, because it's not only been done in Japan, and we're going to look at the Japan incident as well of yield curve control. But yeah, in the US, it was implemented during World War II. The Fed and the Treasury had a pact to keep bond yields, interest rates pegged under control to finance the war. And by 1951, though, they had to abandon it because you had massive price rises, which people call inflation. And that's another thing that you need to keep in mind. Price rises are not inflation. They're the consequence of inflation. It was the yield curve control that created the inflation. And what do I mean by that? Well, it allowed the government to borrow money, and it allowed the Fed to print the money out of thin air to finance the government and keep bond yields or interest rates artificially low during the war. And of course, after the war, they continued that policy, and then you had a massive post-World War inflation. They call it inflation, but it was actually prices rising. It was the consequence of inflation. And the reason I'm saying this is there's a lot of people out there on social media, people even with PhD in economics, and I'm not going to mention names, who are saying that inflation is almost zero, that it's collapsing, that the Fed needs to cut rates. But what they're looking at is some kind of measure called trueflation, which is a basket of prices. If you really want to know what's happening to inflation, Google M2 Fred and look at the chart of M2, which is the money supply growth, and that's at a record. It's even broken out of the top that we saw during the aftermath of the COVID crisis. Yeah. So that's what happened, yield curve control. The Fed and the Treasury tell the bond market, for example, if the 10-year yield goes above 2%, the Fed will step in and print money, or technically it's reserve money, right? It's not the money that we use or the dollar bills. It's called reserve money. They will create that out of thin air. Yeah, that's the magical thing about the Fed, right? It creates value out of thin air, corrupt value, of course. It's not real value. But with that money, they buy treasuries, they drive the price higher and bring the yields back down to 2%. So the market is very aware of these targets that the Treasury and the Fed announced. So a lot of times they don't even test this level, but sometimes they do. So it's like riding a put on the bond market. That's what it is. And to me, that's akin to debt monetization, really. It's debt monetization through the back door, pretty much like QE. And the only reason QE is not debt monetization, and what do I mean by debt monetization? Well, the government buying its own debt, i.e. the Fed buying Treasury debt. And of course they did, but they did it indirectly, right? Let's say, how do they do it indirectly? Well, the Treasury issues 10 billion of 10-year notes on the 20th of April. And then the market makers, the primary dealers, the Wall Street banks, they'll buy that. And then the next day they'll sell it for a slight profit, yet a profit, to the Fed. So yeah, they just act as middlemen. So the Fed doesn't really buy directly from the Treasury auction. That would look too obvious, but it's as good as. And so the first incident of yield curve control was during World War II. I think President Truman ended it in 1951. And we know what happened to the bond market in the next 20 years. Yields kept going up. They topped in 1980 at around 15%, the 10-year yield. Short-term rates went to 20. And I think, eventually the forces of the market and the forces of nature reflect themselves. You can't manipulate things forever. Yes, it took a long time since from the end of World War II and the end of yield curve control for that to occur. But I think we're in the same situation now. And why is that? Well, because the Fed and the Treasury, again, went into this exercise of massive QE in 2008 and 2020 to bail out the banks, to bail out the economy. It's a Keynesian fallacy, right? Not to allow things to liquidate. And here we are. Yes, they have unwound the balance sheet a little bit, but they can't do it anymore. The debt is up to here. It's like 39 trillion almost. And there's no way out. The bull market in bonds is finished. It was finished in 2020, I would say. Yields have crept up. Yes, they've stayed fairly steady the last few years, but the tendency is for them to go a lot higher, and they're concerned. So there is this talk here. There's an article on Bloomberg that came out the last 24 hours. I think it was yesterday. And TF Metals reported here, Fed Treasury Accord is what Bessent was describing in 2025 when he suggested melding together the operations of Fed and Treasury. Well, that's debt monetization, people, and that ends in tears eventually. Again, if you're paying attention, you can see what's coming, which is why gold is $5,000 and continue to rally. So there you go. What about Japan? Well, I had a look at Japan, and I did a little bit of digging. They started their yield curve control in September 2016, and they ended it in March 2024. So about 7 years. And they kept, according to the research I did, they kept the 10-year bond yield around zero. By telling people that if it goes above 0.1, they would come in. So the market was okay with that. But eventually they had to stop that because, the cost of living kept going higher. CPI was too high. Prices were going up. And why were they going up? Well, because they had been inflating through yield curve control, through QE, and eventually it comes back to bite you. They had to stop yield curve control, and we know what's happened to Japanese government bond yields. They've gone through the roof. They're still going through the roof. The market is collapsing. And the other thing I wanted to show you is what the price of gold has done in Japanese yen. So it will give you an idea of what's going to happen to the price of gold in dollars as well. So you can see that back in 2016, it was around 133,000 yen, and now we're almost at 800,000, and I think it's going a lot higher. And even after they stopped the yield curve control, that was actually when the price accelerated higher. And why do I think that happened? Well, because investors were concerned that now the bond market had no support. They had to go to an alternative to a safe haven, and that's why they went to gold. So ultimately, the reason why this is happening is because, our policymakers were not tough enough to let things unravel and let the market take care of things in 08 and 2020, right? And now they've got a problem. And I've told you about this from reading history, right? Fiat Money, Inflation in France by Andrew Dixon White. That's a book I recommend you read. A lot of you have read it, but I'm going to put a link below in the description. Read that, and you understand that this is just like a drug, right? When an addict or an alcoholic, is trying to stop, they can't. They just have to keep going, and it's the same thing here. US Treasury and the world, not just governments, but corporations, individuals, they have an addiction to debt. And they can't stop it. They don't want to go cold turkey. They want to grow out of the debt, right? Like President Trump just said recently. But they don't. And the debt keeps growing. And yield curve control is just a futile attempt, in my opinion, to save things. So ultimately, yes, if they do yield curve control, it won't last forever. And then when they stop it, that could be when things really implode and when gold takes off even more, I would say. And talking about treasuries and gold, I saw that there's an article that came out today, actually, on Bloomberg. It says China urges banks to curb exposure to US treasuries. The article says that it's nothing to do with geopolitics or credit risk. They just think it's because it's volatile, right? But I think there's a lot more than that. And it's interesting this story's come out on the day where they're talking about yield curve control. The other thing that's come out about China that's really interesting, they've kept buying gold, the central bank there. They reported this weekend that for the 15th straight month they bought more gold. Of course, the official number doesn't seem like a lot, but as you can see here, Eric Young posted China is relentlessly buying physical gold. And they have the reported amounts is the pink color, reported PBOC purchases. And then you have the Goldman Sachs estimates of China purchases on London OTC market. So the Chinese know what's coming. Yes, they still have, I think, about 680 billion in treasuries as reserves. The smart money knows what's coming, especially Ray Dalio, the family offices, the hedge funds, sovereign wealth funds, central banks. Do you know what's coming? I hope you do. And yes, I hope you avoid treasury securities and bond securities, or any kind of bond like the plague. This is not advice, it's what I would do, but you need to look into this. The only kind of treasury that might be okay is very short-term treasuries like 1 month and 3 month T-bills. And why is that? Well, because they mature every month or every 3 months, and rates adjust, right? So you don't have the risk of holding a treasury note for 10 years and losing a lot of your capital. So that's why the short-term T-bills are okay. Again, though, if you don't like what your government is doing, not just in the US, but in the UK, in the EU, by buying government bonds, you're actually supporting them. So if you don't like your government, you don't approve of their domestic, economic, and foreign policy, yeah, the best thing you can do is to get out of that market and have physical gold and silver outside the system, especially the banking system. Have some of it in your dirty man safe a little bit, but I recommend a private vault outside the banking system. So let's quickly look at where we are in terms of the markets this morning. It's just before 8 a.m. London time. Spot gold is trading 5,002. It's up 36 bucks. High's been 5,047 and the low 49.64. Silver is trading at 80.75. High's been 82.50. So it's still very fluid, the market, quite volatile. And medium long term, I'm very bullish. How can I not be bullish gold? I'm bearish fiat currencies. But in the short term, we're going to keep seeing paper shenanigans going on. And yeah, ignore that. And keep in the back of your mind that do you really want to get rid of your gold and silver? What's the alternative? It's not very good, is it? So anyway, what about the stock market? Well, the Dow is trading above 50,000. I think that's another illusion there too, because gold is at 5,000. So the Dow gold ratio is around 10. So in terms of real money, it's really not going anywhere, the stock market or the economy or anything really, unfortunately. Yeah, that's what's going on. And in terms of the bond market this morning, yeah, I noticed Treasury yields are up slightly. 10-year yield is up about 3 basis points at 4.23, and the 30-year is at 4.88, up 2 basis points. The key levels there are 4.30 and 5. I think we need to keep an eye on those. And yeah, don't forget, the Treasury has a total of $9 trillion to roll over this year, 2026. Anyway, with that, I'm going to wish you all a very good day. Take care. Bye.